Hello, this is Rajat Bose coming back to you again to offer our latest edition of Nifty, Bank Nifty, Market Outlook, as well as two stocks. This week the market ended at 18203.40. That is the Nifty reading at the end of Friday, May 19th. Prior three sessions we saw that negative candles, black candles on the daily Nifty chart. Nifty broke down the 9-day moving average, 9-day exponential moving average. Also, it tested the lower internal trend line that you can see on the chart. Finally, on Friday, although initially it was showing weakness, after opening around say 18186, the Nifty went down to 18060. That is the low of the week, that is the low of Friday. And after that, in late session, the Nifty actually recovered quite a bit of ground and finally closed at 18203.40. So there is a hammer line, and Nifty has closed above the internal uptrend line, but it has closed a tad lower than the 9-day moving average level of 18212.41. This is definitely heartening because in Friday's session, both the internal uptrend line as well as the 20-day exponential moving average, which was at 18107, was also tested by the Nifty, but the bulls managed to call the shots in late session and finally took the index up to about 18203. They are very much in the reckoning because this hammer line might well be the harbinger of a positive session on Monday and thereafter. One thing I would like to mention here is that as I have been telling, that unless the Nifty falls below 18,000 mark, or rather 17,970 decisively, it is just a course correction. So the foregoing week's price activity is a course correction, but we cannot say that the intermediate uptrend has been terminated. As you can see on the chart, there had been a similar situation earlier. So look at the circle in which the red candles, or normally they should be black candles and the green candles should be the white candles, but these red candles also showed a correction. And this week also, the foregoing week, we saw big red candles between say Tuesday, Wednesday and Thursday, and after that on Friday it closed with a hammer line that gives us some kind of a positive feeling that chances are that the bulls will stage a comeback. Let's see how things pan out, because I mean it is actually quite an impressive close, because the 20-day exponential moving average was tested, the Fibonacci level around 18,074, as you can see on the chart, that was also tested, and the 9-day is almost touched. So there is every possibility that there could be a recovery on Monday. What you now see is actually a 125-minute chart. That means each trading day is divided into 3 candles. It is a 3 times magnification of the daily bar. What you see here is an interesting situation. As you can see, on the daily chart, the earlier chart that was shown to you, the circle on the left was much smaller, but here the circle is very big. So each daily bar or daily candle is actually subdivided into 3 new candles, and These encapsulates 125 minutes of trading activity. So what happened at the end? Look at now look at the top right corner. Top right corner, initial session, you saw the actual low that was made, that is 18060. It happened in the first 125 minutes, and there was a hammer line. After that, there is a small bit of a body, and it was very small. And then in the last 125 minutes, that is 2 hours and 5 minutes, the bull staged a rally. It showed that the bears were forced to cover at the end of the session. Bears were forced to cover, and it is very heartening. Here, the 18196.35 is the 9-unit moving average that has been taken care of at the end, because we closed at the Nifty closed at 18203, and the 20-unit moving average here is located at 18268. And once this is taken out on the upside on Monday, you will find that the bullishness that we saw in the last couple of hours on Friday, that bullishness is being maintained and continued. So what we need to see right at the beginning of the week, that is the coming week, that the Nifty crosses 18268. Once it does that, the next level to watch out for would be 18200 mark. If 18200 mark, because 18203 is the 9-day EMA on the daily chart, and on this 125-minute chart, that is 18196. So this is the level that the Nifty needs to maintain, or rather the bulls need to guard this support area very valiantly. Then the upswing will continue. Otherwise, if 18268 is not being taken out on Monday decisively, then the threat of lower levels below 18203 or even below 18125 could happen. But definitely the last three candles, that is in today's session, the first 125 minute, the middle 125 minute, and the last 125 minute, they are very encouraging for a bullish reversal. Let's see how things pan out on Monday. We now come to talk about the Bank Nifty. The Bank Nifty has actually done even better than the Nifty. It closed 217 points higher from the last close. As you can see on the YTD chart, that is year-to-date chart, it actually encapsulates the trading activity from the beginning of the year to current date, that is the 19th of May, last Friday. And what you see here is that initially on Monday there was a good bullish candle, that was a green candle, and that tasted 151.70, only 10 basis points shy of the all-time high posted on 27th of December last year. In between, it came down quite a bit. Today, of course, we had a higher low, but it actually fell quite a bit and recovered. Finally, we saw the weekly close at 43,969, which is very heartening. Very heartening in the sense that we are only 182 points short of the all-time high of Bank Nifty. And the other thing to note is that the 9-day moving average, despite being tested on Wednesday as well as on the last day of the week, that is Friday, the Bank Nifty recovered and closed pretty high on Friday. This is definitely very encouraging. The recovery, as I said, that was a 430 plus points recovery from the bottom. So chances are that we are likely to see another attempt at crossing the all-time high next week. But We would like to see the magnified chart of 125 minutes. Now what you see on the screen is the 125 minute Bank Nifty chart. Bank Nifty 125 minute chart, the last three candles encapsulate the last trading session, that is 19th of May, Friday's trading session. Interesting part of this is that initially when the market began on Friday, it violated both the 20 and the 9 unit moving average. I'm saying 9 and 20 units because these are not 9-day or 20-day. This is actually 125 minute chart, so that's why 9 unit and 20 unit. The same thing happened on the last 125 minutes of Thursday as well. Both the 9 unit and the 20 unit moving averages had been tested, and finally it closed on Thursday on the 20 unit moving average. But what we see now is that after the similar pattern, similar tasting on first 2 hours or 2 hours and 5 minutes to be precise, the Bank Nifty tested 9 unit and 20 unit moving averages. It posted a doji. Doji means that the open and the close. That's why you see some kind of a cross there. It's a doji cross that signaled that probably there could be a recovery, and exactly that happened. What you see on the last candle is actually a recovery of 260 points from the low, 260 points from the doji's, the second candle, that was the doji, intervening doji. From there the Bank Nifty rallied. That is, from 1:25 p.m. to 3:30 p.m. there had been a rally of 260 points in the Bank Nifty, and the Bank Nifty closed at 43,956, as I said earlier when we were discussing the YTD chart. So Bank Nifty, again, it is within the striking distance of posting a new high. Only 182 points left. Chances are that Bank Nifty might try and post a new high on Monday, but we need to see how things pan out. The volume on the last 2 hours had also been pretty good, so there is every possibility that the Bank Nifty has got back its momentum. Now we are going to cover the CNX MidCap 100. CNX MidCap 100 is the third index that we are covering from this week onwards. We have included this for the primary reason that a lot of people have actually told us that they wanted to know how is the mid-cap scenario and how the mid-caps looking, not just the large caps that are covered by the Nifty and the Bank Nifty. So from this week onwards, we would cover this CNX MidCap 100. Now, the CNX MidCap 100, this is in somewhat, it is a bit weaker than the Nifty and the Bank Nifty. The reason behind that is, if you look at the last 5 sessions, except for the Monday session, there are only red candles on the chart. Although a 33,000 kind of high was scaled up by this index, but that day it was an inverse spinning top. That is the Tuesday's chart. The very next day we saw a hammer line. Normally, an inverse spinning top and a hammer line, if they follow in succession, then what happens is that there is a possibility of a reversal. And that kind of a candle did happen on Thursday. That is, it opened higher and then closed lower, and as you can see on the chart, it closed almost on the 9-day exponential moving average, which was around, say, 32,500. Then today, what happened is that we saw the index went down considerably. It showed a low of 32,232, but finally it closed at 32,550. It closed at 32,550, that is cool 318 points from the low. That is about a percentage point that it covered in the last session. So it is kind of a tentative situation that if the CNX MidCap can scale up further at least to 32,800, better still 33,000 mark in the forthcoming week, starting from 22nd of May, then the mid-caps might perform better. But remember one thing, that this mid-cap index is actually the top 100 mid-cap stocks. Other mid-cap stocks are not covered in this. So again, it is somewhat large cap stocks only. I mean, though they are mid cap, but larger ones among the mid cap stocks. So the outlook is actually on those larger mid caps, which could be whose market capitalization could be more than 50,000 crores. So this mid cap index, as of now, we can say that 9-day exponential moving average at 32,531. That is very crucial, and then there is an internal trend line which is around 32,500. So these levels assume a great importance for the next day, and thereafter we need to watch out for the 20-day exponential moving average, which is 32,132 as at last Friday. So if 32,000, I would say that if 32,000 is taken out by this CNX MidCap 100, then definitely a corrective swing or a corrective phase is likely. But before 32,000 level is decisively taken out, we cannot say that this correction is going to last long. So let's see how things pan out. The CNX MidCap chart, 125-minute candle chart, yes, it is definitely offering much better clarity. Now you can see that chinks in the armor of the bulls, the mid-cap bulls, are clearly visible. If you look at the top right corner, then you will see that there had been two downswings. The last 5 sessions or last 7 sessions, that was pretty bad, except for the last 4 hours of trade. That is the last, on the Friday when Bank Nifty and Nifty was recovering, they were recovering. Then this also recovered to a large extent and closed above the internal trend line. But look at it. Prior to the last 2 candles, the 5 candles that were there, they were red candles. In between, there had been 1 green candle. Other than that, again, we see 4 red candles from the top. This means that the mid-cap bulls are in somewhat a weak situation, and that weak situation will become even weaker if we find that the mid-cap index actually closes below the 50 unit moving average, which is located at 32,276.21. If that level is taken out, then it would be weaker. And as we said while reviewing the daily chart, that 32,000, so 32,276 to about 32,000, this is the range to watch out for on Monday for the mid-cap index, and generally it should not go below 32,000 mark if it were to remain bullish. If 32,000 mark is taken out, then there is every possibility that at least 31,600 to about 31,200 might be seen. But there is a lot of support around, say, 31,333, which is the 200 unit 125 minute candle moving average. So that that will also offer some support. So come to sum it up, what we would like to say is that if it maintains itself above 32,276, then there is nothing wrong. Nothing wrong with the mid-cap, CNX mid-cap 100. And if it were to fall below the 32,000, then it would be weak. It can fall down to as low as 31,333 going forward. That is the level to watch out for, because if that level gets broken, then the mid-cap index would become very, very weak. So let's see, mid-cap index, the CNX mid-cap 100 index is the weakest among the lot. The strongest is the bank nifty and the nifty thereafter, and followed by the CNX mid-cap. CNX mid-cap is more on the weaker side, bank nifty more on the bullish side, and nifty is kind of even Stevens as of now. This time we're going to suggest a chemical stock and a technology stock. You see, India is going to become a chemical hub as per the McKinsey reports. So there would be companies that would actually become market leaders and perform very well. One such blue chip company we are going to discuss today. Apart from that, we are going to discuss a technology stock. No, this time we are not taking up a software stock. You know, you must be using LED TV, laptops, lots of these laptops and LED TVs, or say mobile phones. They may be differently branded, different companies' name you will see on them, but the manufacturing might have been done by Dixon Technologies. So we are going to discuss Dixon Technologies. Dixon Technologies had been a great performer, but there had been a considerable correction in the early part of the year. Around February, it posted a low of 25.53. After that, there had been a flat consolidation. This is base building, this is accumulation. In whatever nomenclature you use, basically what is happening is that after a sharp fall, Dixon Technologies has been gathering steam. Those who had to sell out, they have gone off, they have done their job, and now Dixon is ready for a launch upwards. As you can see on the chart, the 9-day and the 50-day moving average, the 9-day moving average, 9-day exponential moving average is piercing the 50-day moving average from below. This is a bullish sign, and the result of that is also seen on the candle. I mean, it is for the first time we see a green candle. That is, on the last session, the 20-day Bollinger Band second standard deviation, the higher second standard deviation, the whole candle is above that. That shows that it is now about to launch itself on the higher planes. What am I looking at? I am looking at, over the next 6 to 9 months, a level of 3800 to 3850. Prior to that, 3350 and 3600 would be the two targets, and put a stop loss for this stock at 2780. 2780 on closing price basis. I am giving you the stop loss because since I am giving you technical levels, it is customary to offer you stop loss, but those who are willing to stay put for the longer term, Dixon is definitely going to perform really well for them. This is a great stock, is a great company. It will do well going forward. So those who want to stay put in this for longer term than just 9 months or so can always do that, because this is one of the blue chip companies. This is the market leader in LED TVs, and also it manufactures one hell lot of laptops and other computers. This is a company that is really worth getting into, watching out. So go for Dixon Technologies, use your stop loss and targets. That is our technology stock. As I said that India is going to become the chemical hub for the world. It is not what I am saying, it is actually in a detailed report McKinsey has said that we have this potential, and there are companies that are into specialty chemicals, that are into other types of chemical products, and Deepak Nitrite is a blue chip company, not just a recent comeuppance in the stock market arena. It has been there for a very long time. But Deepak Nitrite came to limelight because it became a 10-bagger from the COVID low to the COVID period high. From March 2020 levels around 300, it went up to 3000 on 2021 October. So 10-bagger in a space of 1.5 years. After that, Deepak Nitrite suffered a correction. In any parabolic move, you will see this kind of a correction, but the fact remains that it is not just Tom, Dick, Harry company or a small cap or a micro cap that it will actually go down 100%. It didn't. It came down and it started consolidating between say 1900 and 1700. Consolidation has been for a fairly long period of time, from February to May. Over the next over a period of 4 months it consolidated, and now it is trying to move up. Although on last Friday the stock failed to 1941, it could be that initial profit taking after when you are getting out of a band and all that, but the saucer formation is a very regular formation. I have also remarked about this saucer or rounding bottom formation earlier. It is a favorite chart pattern for me because I know that lots of such saucer or formations or rounding bottom formations have given phenomenal second upswing, and this second upswing I refer to the first upswing that I just described from 300 to 3000. So what is the target? Again, the target would be 3000, but immediately I am looking at a target of about 2250 to about 2500. That is a possibility over the next 6 to 9 months. But Deepak Nitrite ultimate long term target would be 3000. That is the saucer completion target. Mind you, this is a company that maintains a high return on capital which is above 25%, and this is a steady performer. This is going to give you a good solid appreciation if you invest it in for the long term. I would put a stop loss below 1700. 1700, why? Because this is the consolidation level. That's why I am saying if you are uncomfortable using 1700, then use a stop loss of 1810 or so, because that is the bare minimum stop loss. So either you use 1800 or 1700 is your choice as the stop loss, but I would say Deepak Nitrite is going to perform pretty well fundamentally and technically also. The regular pattern of saucer, it may take time, but it will actually go there. There is high probability that such levels would be seen over the long term. It's a long term stake. And I would like to disclose one thing out here, that I am also an investor in Deepak Nitrite. I have also invested in this stock, and I am also looking forward to these targets for the long term. Well, now we have come to the end of our weekly dispatch. If you have liked my commentary on the Nifty, Bank Nifty and the CNX MidCap and the two stocks that I have discussed, you see they are fundamentally sound stocks and they are great stocks that I have already said. Now I would like you to do me a favor. If you like them, if you like my presentation, if you like my choice of stocks, then please press the like button, subscribe to my channel, and also don't forget to press the bell button so that YouTube sends notification whenever I come up with a new video. Thank you.